Hello, everyone. I'm Matt Clark, research analyst with Money Markets, and today, we're doing things a little bit differently today. And before, Charles Sizemore, co-editor of Greens and Fortunes, had a video series where he would talk about various stocks, whether they be dividend stocks, value growth, what have you, and give you his perspective. Well, I kind of want to jump into it because I'm greedy like that, and I wanted to kind of revamp that a little bit, because what's little known about Charles is that one, fluent in Spanish, and two, he has a very unique perspective in terms of the broader economy. Now, it's very important to lay out here that the economy is not the stock market. Okay, we all know that. Most investors know that the economy is not the stock market, but there are factors of the economy that do drive the stock market. There are things that have short-term implications to how your portfolio looks from one day to the next. So I thought what we should do is kind of lean into Charles's experience, because we're talking about the London School of Economics. And I will tell you that the only other school that is as prestigious in terms of its degrees that I'm aware of is Johns Hopkins University, because that's where I went. And so, we're not going to play academia, but I do want to, use Charles's experience in terms of the economy to really take some of these complex topics that traders are faced with on a daily basis and boil them down to simple, essential information to help you bolster your portfolio, make smart decisions, and do smart research outside of what you already get from Charles and from Adam and from myself on moneyandmarkets.com, or whether you are with one of Adam's premium services like Greens and Fortunes or Home Run Profits or things like that. So I want to start today by first off welcoming in Charles, who is joining us all the way from the vistas and vastness of Lima, Peru. He is making his I don't even know if there's like a regularity here, but making his regular pilgrimage to South America for reference, and not to divulge too much because it's really not my place to do so. But Charles's wife's family lives in Peru, so it's not he just spun the globe and
I didn't just abscond. I didn't just flee the country, on the lam or something.
He's
not this time.
And if I do remember right, Peru does have extradition back to the United States, so Peru wouldn't even be the place to go, even if you were.
Oh, no, it doesn't. So they're actually, when you normally see,
Peru,
when you see a lot of gringos down here, you do legitimately wonder what they're up to, because that no extradition thing does raise some eyebrows.
For sure. So Charles is in Peru for the immediate future, and I want to welcome him to this new and improved, or new, I don't want to say improved, but new Investing with Charles video series that we're going to do each week. I'm going to jump in and we're going to talk about various topics, and like I said, really boiling down.
We need you, Matt, to keep me from rambling. I'm known to just go off on a tangent and ramble. This is you're like the shepherd here that just keeps the sheep in line.
I'm kind of the hall monitor to make sure that Charles doesn't run down the hallway and trip and fall and hurt himself. So
with
that's
scissors,
kind of what
maybe,
I'm exactly. So I want to start today because if you watch our video series on YouTube, any of them, whether it's the Bull and the Bear, the marijuana market update, Ask Adam Anything, and now Investing with Charles, we cover a wide range of things. And one thing I did over the weekend during our Bull and the Bear podcast is I talked about the Robinhood IPO. And obviously, there's not a real solid date set for this IPO, but it is gaining a lot of traction in terms of media attention in the financial markets and things like that, because it is expected to be a very big IPO. I say that not because we're going to talk more about Robinhood's IPO, but because what has made Robinhood explode in growth over the last year is boiled down to about 6 stocks. And those stocks are all what you would consider meme stocks. Now, meme stocks is a misnomer. They're not stocks because they're used traditionally on memes that you find on Facebook. That's not what they're for. That's not why they're called that. They're called meme stocks because these are stocks that have received a lot of what you would call retail investor, attention. Reddit, various message boards, things like that. Retail investors, which are, let's be clear, retail investors are investors that are not big institutional market makers. They are not big firms that place orders for millions and millions of shares of stock on a daily basis. Retail investors are like you and me, and I mean we're trading shares, but we're not doing it nearly to the volume. So that's a retail investor. But retail investors, we're drumming up support for stocks like GameStop to start, BlackBerry, AMC, I believe there was a solar company in there. Solar Edge might have been one, or Sundial. One of those two were in there. There was a few.
Oh, that one I missed. A lot of these are sort of COVID reopening plays, or like
exactly
deeply beaten down value stocks. Many of which actually did have some value. Like this is where it gets funny with meme stock land. It's not that these people were crazy or that the original investment thesis was that off. A lot of times it was actually spot on. If you looked at the original investment thesis for GameStop back, good night, what was that? 7-8 months ago. The investment thesis was, look, this is a heavily shorted stock where anything, you just light a little match here, kaboom, you're going to have a short squeeze, an epic short squeeze. And that's exactly what happened with GameStop. Now, what happens is some of the Johnny come latelys didn't quite understand the nuance of what a short squeeze is and kind of jumped on too late and got burned. But in a lot of cases, anyway, regardless, the fundamental reason to enter the trade was valid. What happened was it's meme stock. It's fueled by social media. It's fueled by a lot of regular and oftentimes inexperienced investors trading stock tips via social media, and they don't always kind of know the inside scoop, right? And so what happens is these things take on a life of their own, and you get something like AMC, which I wrote about in Money and Markets recently. With AMC, the stock blew up from less than $10 a share to over 60 in a matter of weeks, and there was no. And what gets interesting is it's not like AMC was on the ropes. It was about to be bankrupt because of the COVID shutdown, and now it's just kind of this is a recovery rally. The shares are trading well above their pre-pandemic levels. You could make a case for, the shares need to recoup a lot of their losses and trade near pre-pandemic levels, maybe. But what happened was they overshot that. This is an industry, by the way, movie theaters, that was suffering long before anyone had ever heard of COVID-19. The abundance of content on Netflix and Amazon and everything else that you can watch in your house on a massive big screen TV, pop your own popcorn and not have to listen to a baby cry or someone cough and sneeze the entire time. And that was, again, pre-pandemic. It had its appeal. The movie business was not doing all that well. And then, of course, COVID comes along and blows it up. Well, so this is where you look at the price action and you're like, good night. Who is doing this? This doesn't really make sense. Where I would go with this is not to go on like a lengthy tirade about why, and then this is why Matt's here, to prevent me from going on a lengthy tirade. But
again, traffic cop, and I'm holding the stop sign
to prevent. Yes. Anyway, the point is not to bash, meme stocks or the people trading them. It's more just to keep a little perspective here. So there's nothing wrong with trading these things. This is where the action is. Again, AMC stock went up by a factor of, I think, 6 or 7 from its recent lows to its recent highs. Of course, it's given back half that, but what a run. If you had gotten in close to those lows and sold close to those highs, you've made your money for the year. You can just take the rest of the year off. So I'm not ever going to tell anybody to avoid these, because this is where the action is. You can make a ton of money. I'm just going to recommend you be careful. This is not, when you see this kind of action and valuations that don't make sense. It doesn't make sense that AMC trades at a premium to its pre-pandemic levels. It doesn't make sense. You don't want to stick around too long. If you do decide to trade these stocks, trade them, have fun. Have an exit plan, be disciplined, and know when to get out. And for each person, it's going to be a little bit different, but just set your rules before you get in the trade so that you limit your losses and you know what you're up against. Because the meme stock thing, this is almost a distraction from the bigger picture, which is the overall nuttiness of the market right now. The same thing I'm telling you about meme stocks, I could tell you about the market as in general. We are out, but by many metrics, we are now actually more expensive than during the peak of the .com bubble in 99, 2000. And by other metrics, we're catching up fast. It's crazy.
Yeah. And to put it in perspective here, especially with AMC, just to kind of put a finer point on it, I pulled up a 3-year chart for AMC. And its previous high was set back in September of 2018, and that high price was $18.69. Prior to its run up in January of this year, when it became kind of the new meme stock, it was at $2.14. COVID took just beat that stock down, entirely. So it was at $2.14. And you have to think that its metrics in terms of its valuation metrics, price to earnings, price to sales, price to book, price to cash flow, were all very low. So it made it a very good value stock. So in theory, as an investor, whether you're retail or whatever, you're looking at this, you're thinking, okay, well, the growth really isn't there yet because they're still closed, but they're going to open eventually. So you're going to see that. Right now, value-wise, price to earnings.
Actually, it was a bit more more extreme than that. It was this stock could go bankrupt. It could.
Exactly.
The way I think, but it could also triple. So it was a situation where a reasonable investor could have said, look, I'm going to risk losing it all because I think the upside might be 3 or 4 times from that $2 level, right?
Right
now,
right. So you're at $2.12. Let's just say, I think that's right of the low back on like December 28th. It reached a high point on, I believe, the middle of June 14th, June 15th, where it hit right around $60 a share. It has pared that back now to its price at around 33 a share. So it's still very high. And just to put all this in perspective, what we're talking about here is that these stocks have risen without any kind of technical or fundamental analysis to back up why they have gone up. It's just you have a pool of retail investors, a massive pool of retail investors that are buying the stock to drive up the price, and there you have it. And then they all benefit. And what the end game here is, we want to try to hit larger, more institutional investors in a short squeeze to force them to have to lose millions, and in some cases billions of dollars in their short plays. But what we're talking about here is valuation. And this is a key metric. These are key metrics that you have to look at when you're thinking about what you're going to buy next. And that is, like I said, a price to earnings, price to sales, price to cash flow, price to book. Right now, for AMC specific, its price to earnings right now and its price to earnings long term are not even available, because the stock price is so high compared to what its potential earnings are that it's kind of off the chart. Another perspective.
Well, no, their earnings are also negative. So like you're comparing the price
earnings are negative,
to non-existent negatives. Sorry, non-existent earnings.
If you want to look at a positive, in terms of positive earnings, but a very high PE ratio, you have no further to look than Tesla. Tesla's P/E ratio right now is 380 compared to the industry average, the auto industry average, which is in the 30s. I mean, it's a massive. So if you look at that, you look at the rest of the auto industry is at 30. That means the average auto stock is trading with a price to earnings ratio of around 30 to 40. Tesla is priced so high.
By the way, about that, auto stocks usually aren't that high. The reason the PE ratio is as high as it is for auto stocks right now is because earnings took a bath over the last year, and so your comps aren't real good. Your that denominator effect is not in your favor. Auto stocks regularly trade in single digit PE ratios. It's not abnormal at all to see Ford or GM or Toyota trading at 9 times earnings or 8 times earnings. That's kind of normal, actually, or at least has been for the last several years.
And the only metric that actually is available for AMC is its price to sales. This is basically the price of the stock price, the share price as it is today, as a ratio to its overall sales. And right now, AMC is at 31. The industry average for entertainment is 5.
Yeah, and the S&P 500 is 3. So that shows you.
So you're looking at between a 6 and 10 time expansion in terms of its price to sales. What all this tells us basically is when you see these high price to ratios, especially compared to the industry or to a benchmark like the S&P 500, is where you come up with overvalue and undervalue. Okay, you have stocks where they may be in line, and that could be considered kind of at value. You may be lower, they may be a little undervalued, or they could be just way up in the stratosphere like an AMC or a Tesla. And these are considered overvalued, which means by their metrics, their stock price is way too high to be supported by by fundamental analysis. And we see that, but it's not just meme stocks. And this is another reason why I want to bring in Charles, because I want to look at the larger market. Let's look at the larger market in terms of these ratios. Where are we at right now in terms of where stock prices are compared to where they, I guess, theoretically should be?
Yeah, sure. I'll start with the price to sales ratio. I don't really like to use the price to earnings ratio for the general market because it can really be affected by a single year. It moves too much, right? I think it's smoother to use the price to sales ratio or the cyclically cyclically adjusted. Didn't have my cup of coffee this morning. The cyclically adjusted price earnings ratio, which takes a 10-year average of earnings to smooth things out. So we'll look at both. I'll start with the price to sales ratio. So I used to think that a price to sales ratio of 2 is getting a bit frothy because back in late 90s, early 2000s, when we had the biggest bubble, the biggest stock bubble of our lifetimes. And, if we lived to be 100, we may never, I would have thought that we would never see something like that again. Well, where are we now? The price to sales ratio on the S&P 500 is, and let me get an exact current number as of right now, 3.12. So we have gone far. We are now fully 50% higher than what I considered kind of the upper limit of where the S&P 500 could ever reasonably go. Fully 50% higher than that. And that's not really, the denominator effect is there a little bit because, sales are a little bit depressed still, but not much. Earnings are depressed, sales really not that much at this point. So most of that is just valuation. The cyclically adjusted price earnings ratio, I think, is also interesting. Why is it a 10-year average? Why not 5? I don't know. 10 is a round number, honestly. And within a 10-year window, you've generally seen everything. You've seen a boom, you've seen a bust, you've seen a recovery, you've seen sort of the whole economic cycle, and generally speaking, in any 10-year window. This is an old metric that Benjamin Graham, I could consider the father of the modern investment industry. This was something he wrote about in Security Analysis. So you take a 10-year average of earnings, you compare that to current prices. It's good for comparing markets across time. This is where it gets fun. So the peak in the dot-com era, we still have not reached that. The peak in the dot-com era was 44-ish, 45, mid 40s anyway. But right now we're at 38, which is, again, a level I never thought we would hit in my lifetime. After the excessive valuations of the 90s, I really never thought we would see a CAPE anywhere near, high 30s. I never thought I'd see it. And here we are. So we are, now valuation is not everything, of course, in our own, in Adam's, the green zone ratings model, it's one of 6 factors, so clearly valuation is not everything, but it's still a big deal. And it's, would you rather buy low and sell high, or, you can buy high and sell higher on a momentum play, sure. But clearly, the higher the market goes, the higher that basis is, the less attractive your potential returns look going forward. It's basic math, and that's where we are right now. So, you have to really be careful buying and holding this market. I think this is not really a good time to buy and hold. I think this is a time to be selective.
And that led me into kind of my final question here. And that is, understanding this information and knowing that things are overvalued. And it's not really a secret. It's not as if we're revealing something that you don't see. I think it's very common knowledge at this point to understand that by and large, most of the market, whether it be the S&P 500, the Dow, the Russell, whatever you're happening, whether you're in a large cap, small cap, mid cap, whatever, or sector, by and large, most everything is overvalued. It doesn't mean they all are. And there are still great value stocks out there. To which you can find, and a shameless plug here is, if you're looking for great value stocks, you can use our green zone rating system on Money and Markets and find those stocks that actually score very high on our value metric, which actually takes all that into account, takes its price to ratios into account. But as an investor, what do I do with this knowledge? What do I do with this information? I see that everything's overvalued. Does that mean I should just stop and not buy? Should I, maybe sell everything because it's all overvalued and it could pop at any time? What's the best approach here?
So you dig a big hole in your backyard, you put all of your money in mason jars and you bury it. But no, what I would recommend a couple of things. I'm not recommending you jump out right now. This past week, it's been a bit volatile, that notwithstanding, we really are still in a bull market until we see otherwise. Right now we are still in a bull market, so you want to participate. But I would say maybe keep a little more cash than usual on hand. If your normal orientation is to be 80% invested or 90% invested or whatever it is, do a little bit less, keep 10% extra in cash, 20% extra in cash. If you're feeling a bit nervous or you're close to retirement, maybe keep 50% in cash. I don't know. I mean, it depends on the person, but keep more than you would normally keep in cash. That's only prudent right now. Two, do keep in mind that we may not, stocks are expensive right now, and I would argue overpriced. That is a somewhat relative term because we do have, interest rates still at zero until the Fed does something. And we do have high margin tech stocks as a bigger percentage of the index than they've ever been in history. So a degree of overvaluation should be expected and is fine, just not as much as we have today, right? So I would say, you don't have to wait for that perfect, so-called fat pitch moment to swing. You can be swinging here, but you might not want to swing for a home run. Swing for some base hits and doubles, if you will. But this is not a home run market. And then beyond that, just be selective. We tout our green zone model because we believe in it. It works. And using that to sort of cherry pick stocks that have the right criteria in place, not too overvalued, at least relative to this market, showing some good momentum, showing some good growth profile, showing, lower volatility. These are the kinds of things you should be looking for right now. So I would say, just, keep a little extra cash on hand, keep some perspective, and just be selective in what you buy.
Good advice. Good advice. And we're going to do this every week. And what I want to encourage you to do is, if you have a question that maybe you'd like Charles to look at, or maybe not necessarily a stock, maybe a sector, or maybe an economic thing, if you want him to kind of dive deeper into inflation and explain what that is, please, send us an email. You can send that to feedback@moneyandmarkets.com. We'll try to put a little email address down below here. And also check out our other video series on YouTube. We've got the Bull and the Bear podcast, which is every week, the marijuana market update, as well as Ask Adam Anything. And then don't forget, we also have a membership community on our YouTube channel now where you get exclusive content related to the cannabis market and investing. You can click the join button down below here and you can find out much more about what is available out there. We're doing more exclusive videos, blogging, content, all that sort of stuff that is available to you through our membership community. I encourage you to do that as well. So again, feedback@moneymarkets.com. If there's anything that you'd like Charles to kind of look at and give his unique perspective on the market conditions, maybe particular sectors of stocks that you're looking at, anything of that nature, would love to get your feedback on and get your questions on. So, and also check out moneymarkets.com each and every day, where Charles, myself, Adam O'Dell, our entire team work very hard, 7 days a week. We work all 7 days. Doesn't matter where we're at, doesn't matter what we're doing. We are like slave drivers. We are putting the nose to the grindstone to provide you safe, sound, smart, simple, profitable investment information for your portfolio. So I want to thank Charles Sizemore for jumping in on here. We're going to do this every week. Looking forward to it, and look forward to hearing from you guys out on YouTube to find out more about what you're interested in and what you'd like us to talk about, and get some of your questions answered from Charles' perspective. So until then, I'm Matt Clark, research analyst with Money Markets. Charles Sizemore, he is in Lima, Peru, and he is the co-editor of Green Zone Fortunes. Until next time, everyone, safe trading.